Now, if we look at the market for the last 30 years, okay, 87 to today is the S&P 500, we see that it has soared, especially over the last decade, gone from around, let's call it 220, all the way up to 2,759, where it is today. And so you would think, hey, if you've been invested in the market for the last 30 years, your money should be up 20, 25 times. And if you're just tracking the index, you'd be correct. Your annual performance figures are going to look something like this. So $100,000 invested back in 1986, growing at the rate the market goes, would have ballooned to $1.945 million at the end of that 30 years. So a gain of just over $1.8 million. Now that sounds great, right? Your money's up roughly 20 times. You'd be pretty happy with the results. However, if you were invested in a mutual fund, I can guarantee you your performance was nowhere near this. And the reason is fees and expenses. Now, I used to be a VP over at JP Morgan. I was a financial advisor. I used to sell this stuff. Look, there's a reason I'm not in that business anymore, and it is this. Mutual funds are the greatest con that has ever been pulled in the investing public, and they have one very specific purpose: to suck the money out of your account and put it in their own. And I'll show you what I mean. Now, the main expense most people know about is something called the expense ratio. This is what the mutual fund charges you each year to manage your money. Now, the average fee as of about 2 years ago was 1.25%. Doesn't sound like a lot, but over 30 years, it's going to add up to a little under $300,000. However, there are 4 more expenses that most people have no idea about that are demolishing your gains. The first one, cash on hand. Now, cash on hand is very specific to the mutual fund industry because they have to keep a certain percentage of that fund in cash ready to pay out people at the end of each day who decided to sell their shares. And because of that, that means the fund can never be fully invested. And so if it's not fully invested, you're not getting the full performance, and that costs you almost 1% per year. Again, doesn't sound like much, but over a 30-year time horizon, it's going to cost you in the neighborhood of $191,000. Now, the next fee is also the largest, again, never talked about, but that is transaction cost. Now, you don't see trades going in and out of the mutual fund, but they have to continuously buy and sell stocks to keep the portfolio balanced, to keep it in line with the indexes if it's an index fund, and all that trading costs money. That ends up costing the average investor around 1.44% a year. Again, over 30 years, around $331,000 that's costing you. Now, the next one's a pretty fairly obvious one, but again, brokers don't have to disclose this, and that is their personal commission. It's usually pretty small, around 0.25% or 25 basis points. In the business, we used to call this a trail. Right? They tell you a mutual fund, they get a commission up front and then a 25 basis point trail, or 0.25% of your money paid directly to them each and every year. Very, very small fee, but once again, over the lifetime of your investing, it adds up pretty quickly. And then finally, there is another expense to you, and that is extra or additional capital gains. Now, most of us know you buy a stock, your mutual fund, you hold it for a year longer, you sell it, and then the taxes you pay are capital gains, around 15 or 20%. But what you don't realize is that the mutual funds, with all their buying and selling inside of that, oftentimes have to buy the stocks that are very hot, sell the ones that are losing, and that causes them to incur additional capital gains that the fund must pay. They're not paying this out of their pocket, they're taking it out of the big coffer. That means you're paying those additional capital gains costs. You don't see it, but it's sucking another 1% a year out of your account, adding up to around $230,000. So, in total, with all of these costs, fees, and expenses, you end up losing about 4.77% every single year that you were invested in this mutual fund. Over a 30-year lifetime on a $100,000 initial investment, that would cost you almost $1.1 million. And I'll show you what the table looks like so you can see the dramatic difference between investing in an index and investing in a mutual fund. Look at the difference there, a total gain of $1.845 million versus only $400,000. And here's a chart of the same data. Now, if there's anything between your ears, this is probably beginning to scare you. A lot of people have never seen this with the hard numbers put in front of them, with all the fees and all the costs and all the expenses added up, and realize the extreme impact it has on your retirement dollars. If you want to get shocked a little bit further, let me show you where your money actually goes. This is showing you, in that previous example, over 30 years, where the money ends up. Okay, remember, it's your hard-earned dollars, your investment account. The fund manager, the guy clicking on the mouse, managing the money, ends up with around $288,000. almost $200,000, 191 grand ends up just being wasted sitting in cash that could have been generating returns. Wall Street ends up with around 330 grand in the form of commissions and trading expenses. Your broker, just his personal cut is around $57,000. The IRS, between the taxes they collect from the mutual fund and then the ones they collect from you after you get the net, gets around $291,000, and you just barely make more than the others, winding up with a profit of around $345,000. So take a look at this and ask yourself one question. Do you want to give Wall Street 300 grand? Do you want your fund manager to make 288 grand? Do you want to give the IRS 290,000, your broker 50 G's? Do you want to see $191,000 just wasted sitting there doing nothing? Or would you like to keep 95% of these dollars?